Hello and welcome to this session in which we will discuss the Coverdell Education Savings Account. Savings account, for what purpose? To pay for qualified educational expenses for a person, for a beneficiary. They're designated for a beneficiary such as a child. The purpose of this is to help what? Help you pay for your education expenses. The cost of education in the US has been rising faster than inflation. So the government is trying to give you some tax-efficient vehicles to save, encourage you to save, to do what? To pay for your child, grandchildren, education, so on and so forth. However, the ESAs are not only for college, like 529 plan. You could use this money for primary school, which is elementary education, grade 1 through 6, secondary education, like high school, as well as college students. So notice here, you can save money not only for college and can get some sort of a tax advantage. Now, what's the tax advantage? This is what we'll need to discuss in this session. But the point is you can put money away and use it for elementary school, high school, college. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Let's start by discussing the contribution to these type of plans. The contribution to a Coverdell is not tax deductible. What does that mean? It means there's no benefit today. So you put this money away. There's no specifically no benefit, no tax benefit. Why there's no tax benefit? You don't get a deduction. This means the money put in the account is already taxed. What is the advantage then? The advantage is this money will earn income, will earn profit tax-free. It will grow, the account grows tax-free as long as what? As long as you use it for qualified educational expenses. Now bear in mind, the government is generous to a point. How much can you contribute? Well, you can contribute $2,000 for one person. So each individual can have a $2,000 account that you can contribute to that account, but that's the maximum. So if the parents, they have 2 children, for each one they can contribute $2,000. Let's assume grandparents, they might have 10 grandchildren. Well, then they could put for each one of them $2,000. And this is good because why? You are putting money away for educational purposes. You can put money away, take it away for estate planning. You don't have to keep it in your estate. It helps. Now, the income restriction. Now, bear in mind, also, you are limited to $2,000, and if you make so much money, well, guess what? The government says you cannot contribute. For unmarried individual, their modified adjusted gross income, let's just say adjusted gross income, they don't specifically, go into modified. So an unmarried individual, which is single, they can contribute as long as their income is not above 110. If it's above 95, they will start to trim it down till 110. So it will start to phase out from 95 to 110. For married couple filing jointly, it starts at 190, ends at 220. Now bear in mind, those limits will change. So if you're looking at this in a future year, say those numbers don't match. Yeah, they don't match, but there's a limit and there's a phase out. So make sure you know what the phase out is. Also, what you need to know, the designated beneficiary, the person that you open the account for, must be under the age of 18 when the account is established. And contribution can be made until the beneficiary reaches 18 unless there are some special needs beneficiaries. Again, how many number of people? There's no limit to the number of beneficiary you can have, but each one of them must own their own separate account. And what's the limit in that account? $2,000. We could have many of those. Qualified expenses, funds from this Coverdell ESA can be used for various educational expenses. Remember, elementary school, high school, college, books, supplies, and in some cases, room and board, of course, tuition. So what is the tax advantage of it? So you're putting money away. You are not getting any deduction right now. So what's the advantage? It grows tax-free. And as long as the money is used for qualified education, it's not taxable. So the primary advantage is that interest, dividend, capital gains within the account accumulate without being taxed. Also, when they are used, when the funds are used, when the funds are distributed to pay qualified educational expenses, both the principal and the earning of the distribution are tax-free. Similar to what? In concept and taxation, similar to the 529, as long as you use this money for qualified educational expense. Now, how about if you don't use the money, or if you take more money out and you did not use it? If there's a distribution exceeding the qualified education expense, the earning that's in excess, it's considered what? It's taxable income to the beneficiary. Also, it could be subject to a 10% penalty. This sounds like a 529 plan. Yes, from a tax perspective, basically the same. Age limit: funds in the Coverdell must be used by the time the Benny reaches 30 unless they have a special need. Simply put, you have to use this money by the time they are 30. If there are any funds remaining after they reach this age, which is 30, it must be distributed. And those distributions obviously are subject to income tax and a 10% penalty if paid directly to the Benny. Or who they could be paid for? Can you take this money and put it in someone else? Could be. There's no double dipping. What does that mean? Interaction between this account and tax credit. Remember, a taxpayer can claim related tax credits such as the American Opportunity Tax Credit and the Lifetime Learning Credit. Remember, those are tax credit. To qualify for the tax credit, you have to pay for education. Now, when you pay for education from the Coverdell money, you cannot count this payment toward any tax credit. Simply put, you cannot double dip. You cannot put money away, have it grow tax-free, take it out, paid for qualified education, not taxed, then use that money to claim a tax credit. You can't do that. That's what we mean by double dipping. So the crucial point is that distribution cannot be used for the same educational expenses for which the tax credit is claimed, because you're already getting a benefit that it's not taxable. The earning is not taxable. And this rule ensures that taxpayers don't double dip in receiving a tax benefit for the same expense. So you are receiving a tax benefit for taking this money tax-free, using it tax-free, then you cannot claim it for tax credit. Let's take a look at this multiple choice questions from farhatlectures.com. What is the tax treatment of distribution from a Coverdell ESA used for qualified educational expense? So what's the tax treatment? You took money out and you use it for qualified educational expense. How is that money taxable? Distribution are taxable but without penalty. Distribution are partially taxable. Distribution are fully taxable. Distribution are tax-free but with a 10% penalty. So which one is the correct choice? Well, if you take this money and use it for qualified educational expenses, distribution are fully tax-free. Why? First of all, the original amount that you put in, the principal amount, was already taxable. So this amount was taxable. So it's going to be that amount plus the earnings. And this is the benefit of the ESA. The earnings are tax-free. The earnings are tax-free. So the original amount, so let's assume you put $10,000 and that $10,000 earned $3,000. The $10,000 already taxable. So it's tax-free because it's already taxable. The $3,000, as long as you use the $3,000 to pay for qualified educational expenses, it's tax-free. Therefore, the answer, distribution are fully tax-free. Now, there's a penalty, a 10% penalty, if you withdrew more than what's needed. It's not partially taxable. It could be partially taxable as well, because some of it could be used for educational purposes, some in addition, which is subject to a penalty. Distribution are taxable without a penalty. No, they could be taxable with a penalty. So the best answer is distribution are fully tax-free if used. Notice here, used for qualified educational expenses. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you do what? Understand this concept. Coverdell Education Savings Account. Very important topic for the CPA exam, the enrolled agent, as an accounting student taking a CPA review course or an accounting course in college. Invest in yourself. Invest in your education. Good luck. Study hard. And of course, stay safe.